All right, let's talk about BellRing Brands. On November 18th, they dropped their Q4 earnings. And whoa, what a day it was. We're talking about one of the wildest, most volatile trading sessions you can imagine for a company like this. It was a total masterclass in market psychology, where the story just completely flipped from what we saw in the pre-market to the final closing bell.
So what in the world happened here? You've got this headline, a beat on revenue, a miss on earnings, and a stock that swings a massive 17% in a single day. You see, the company came out with a really solid top-line number, but they missed on the bottom line, and their guidance for the future was, let's just say, a little weak. The market's first reaction, absolutely brutal. But then by the end of the day, the stock did a complete 180. So we're going to break down all the numbers, we'll unpack that whole narrative, and try to figure out what this means for the stock from here on out. Okay, so first things first, let's look at the headline numbers that really kicked off all this chaos. Because right on the surface, this report was a classic mixed bag, and it sent some seriously conflicting signals to investors from the get-go.
And right here is where that disconnect just becomes crystal clear. Look at the revenue. It came in strong at $648 million. That's a 16.6% jump from last year, a really solid beat. But then you look at the adjusted earnings per share, 51 cents. That was a miss. And the real kicker, the thing that made everyone gasp, that adjusted gross margin. It just collapsed. We're talking down 620 basis points. For those of you keeping score, that's a massive 6.2 percentage point drop. Yikes, that set off alarm bells everywhere.
I mean, you really can't argue with that top-line number. A 16.6% growth is seriously impressive. And this was almost all thanks to the sheer power of their flagship brand, Premier Protein. Sales for that alone jumped 15%. And get this, consumer demand for the ready-to-drink shakes was up a staggering 20%. That just goes to show you how strong the brand and the whole category really are. But, and this is a huge but, this was the number that just torpedoed the stock, at least right at the open. That 620 basis point drop in margin, it was caused by a perfect storm, really. You had higher costs for whey protein, they had to spend a lot more on promotions to fend off new competitors, and they had some one-time costs from a packaging redesign. All that just completely erased the benefit of those great sales numbers and led directly to that earnings miss. So what you have here is this epic battle, right? It's the powerful growth engine on one side clashing with this really severe margin squeeze on the other. And when the market opened, well, the margin squeeze story won the first round, hands down. The stock just cratered.
And this table really gets to the heart of that whole bull versus bear debate. It's two completely different stories. In the bull corner, you've got this amazing growth narrative. Dominant brands, people are buying more and more, cash flow is fantastic, and management is using that cash to buy back a ton of stock. But in the bear corner, you have the margin story. You've got relentless cost inflation, rising competition that's forcing them to spend more on ads, and, oh yeah, a looming tariff headwind that's probably going to slice another 120 basis points off margins next year.
You know, the big sell-off wasn't just about the margins in Q4. It was really about what's coming next. Management came out with guidance for fiscal 26, and it was weak. They're now expecting growth to slow down to just 4 to 8%. They even called for sales to actually decline by about 5% in the very next quarter. On top of that, they said full-year EBITDA margins are going to fall to around 18%. So you throw in more competition and this little legal investigation hanging over their heads, yeah, you can totally see why sellers just rushed for the exits at the open.
But then, something pretty incredible happened. After all that initial panic and selling, the whole story started to change, and it led to one of the most dramatic, whiplash-inducing reversals we've seen all earnings season.
I mean, just look at how this day played out. It was pure drama. 7 a.m., the press release hits. Stock's down about 5% before the market even opens. Then at 9:30, the bell rings and the stock just gets hammered, plummeting almost 15%. But then, throughout the afternoon, the buyers started to show up. The stock clawed and scraped its way back, eventually turning positive, and by the time the closing bell rang at 4 p.m., it finished the day up 2.5%. What a wild ride. Absolutely insane.
And let me tell you, this wasn't some low-volume drift higher. Nope. This reversal happened with huge conviction. Trading volume just exploded to 6.1 million shares. That's nearly double its average. What that tells you is that there was a fierce, high-stakes debate happening in the market between the bulls and the bears, and by the end of the day, the buyers had won, decisively. So the big question is, what turned the tide? Why did it bounce back so hard? Well, as investors actually listened to the earnings call and had time to digest everything, they started focusing on the long-term story. Management sounded really confident. They kept hammering home Premier Protein's #1 market share and its super loyal customers. They reminded everyone about that huge $473 million stock buyback, and they pointed to some really interesting long-term tailwinds like new products in the pipeline and even the rise of those new weight loss drugs, the GLP-1s, which actually tend to make people consume more protein. So, slowly but surely, the market started to see the weak guidance not as a catastrophe, but more as management just resetting the bar lower, de-risking the story.
Now, this might actually be the most important takeaway from the entire call. Management officially hit the reset button on the company's long-term growth expectations. This was a huge moment. It was them signaling a shift away from being a hyper-growth story to becoming a more mature, steady compounder. So here's the before and after. They basically just recalibrated their targets for the long haul. The old plan was to grow sales 10 to 12% a year. The new plan, a more modest 7 to 9%. Now, they did keep their profit margin targets the same, but they basically admitted, hey, look, it's a tougher, more competitive world out there, and it's just plain harder to grow at that super fast pace now that we're a bigger company. This was the piece of bad news the stock really needed to swallow, and once it did, it found its footing and was able to climb higher.
All right, so now that the dust has settled from that absolute roller coaster of a day, it's time for our forward-looking analysis. This is the next call. And this really is the million-dollar question, isn't it? After all that chaos, after the reset in both the valuation and expectations, what do you do with BellRing Brands? Is it a buy, a sell, or a hold?
And once again, this really sums up the debate that we saw play out in real time on trading screens. The bulls are going to point to the fact that this is the #1 brand in a category that's still growing. They'll talk about the aggressive buybacks and how the valuation has been brought down to a more reasonable level. But the bears, they're going to fire right back, pointing to that intense, ongoing margin pressure, the fact that growth is officially slowing down and that competition is only getting tougher. And you know what? Both sides have really good points.
So, where do we land? Our rating on the stock is market perform. Look, the long-term business is solid, and management did the right thing by resetting the bar to a level they can actually hit. But those near-term headwinds, they are significant. The pressure on margins is very real, the competition isn't just going to disappear, and frankly, we need to see them execute and prove they can stabilize things before we can get more bullish. Right now, the stock feels like it's priced about right.
Okay, now for a potential trade idea. Here's the thinking. The stock has been de-risked for sure, but there isn't a really obvious immediate reason for it to shoot higher from here. So one way you could play this is by considering selling out of the money puts. For example, something like the 2250 strike puts that expire after their next earnings report. Here's the logic. You get to collect a premium, cash in your pocket right away. If the stock just kind of stays flat or even drifts up, great, you just keep that premium. But if it sells off hard after the next report, you'd get to buy the stock at a price that's actually below the recent lows. It's a way to get paid to wait. The #1 thing to watch for, the next quarterly report. We'll be looking for any sign, any at all, that brutal margin compression is finally starting to ease up.
And of course, this is not financial advice.